now like to ask Zienzi to give her opening remarks and share a private sector viewpoint. Thank you.
Thank you, Chair. Thank you, Honorable Minister, who is on the panel, Dr. Mayaki, in his absentia. I would also like to thank the ministers who are in the room, leaders of industry. Thank you for attending. Special also mention to our Barclays chairperson for Barclays Zambia, who is here. Thank you for coming, and the CEO for Barclays Zambia. Now, I'm here not only representing Barclays, but also talking from a private sector perspective when it comes to banking projects on the continent. Just leveraging on the speech from Dr. Mayaki, the key issue here is there is an investment gap. And the investment gap that we are looking at on the back of the pillar projects, we are looking at about $92 billion that would be required every year for us to be able to close the infrastructure investment gap. Now, how are we going to do it? It's very clear. Government alone, they are not going to be able to do it. Even if government were able to do it, they don't have the capacity. So the fiscal space is very limited. Looking at, again, the debt sustainability ratios for governments, most of the governments, they are probably breaching, some of them, some are reaching their debt equity, debt GDP ratio. So again, that calls for private sector funding. Now, private sector funding, it is there. I don't think there is a shortage of private sector funding, but the issue is bankable projects. Now, bankable projects, for projects to get to a bankable stage, they need to be prepared. Now, that takes us to project preparation. At that stage, most of the projects, they've been stuck at that stage. Now, there is a need for collaboration, and I'm not only talking private sector, but also DFIs. We really acknowledge the work that the likes of African Development Bank have been doing to help government, public sector get the projects to a bankable stage. Now, capacity is an issue. There is a need to build capacity, a need to understand, even when we talk about delivering the projects maybe through PPPs, public-private partnerships. What does that mean? Understanding even the risk-sharing clauses within the PPP agreements themselves. So I'm here to say cheap is not cheap. You might get maybe a package that is presenting maybe 2% interest rate, but if one calculates the total cost of that project, it might be much more expensive. So it's important to understand the risks that are inherent in any PPP project before signing it off. So there is some work that we as Barclays have started doing together with NEBAD to help PPP training for government officials. It's still at conceptual stage, but this is really part of our contribution. How do we work together with governments? The other point is when we talk about de-risking, what does that mean? It's really about being able to package a transaction which will be acceptable to a funder. Given the risk issues, we will never be able to eliminate the risks 100%, but the risks have to be acceptable. Now, the other risk issues that one has to think about is political risk. Now, political risk will never fly away, but it has to be acceptable. Now, political risk cover, it is there, but it comes at a cost. Insurance, we've got the likes of ATI, Lloyd's of London, they do provide political risk insurance, which is great, but it comes at a cost. So again, there's also a balance here where we talk about risk-return trade-off, which means as the risk profile, the political risk profile of a country goes up, the cost of funding also goes up. The other area that I would also want to touch on is when you talk about infrastructure, the PPPs, there is also private participation. And it's important, I think that's why we're having this session, to also get a view on from the likes of construction companies. I see Group 5 are represented here. What is it that they require, from a PPP perspective? So it's good that we are having this conversation, so that when we leave this room, we are leaving with very clear, expectations, and not only expectations, but very clear milestones that will be followed through and reported back at the next meeting. Pension funds are also very key. $100 billion or so. Don't hold me to the number, but the number is very big. Funds that are held in pension funds. Now, pension funds, what we are also picking up is that infrastructure is becoming an emerging asset class for pension funds. But some pension funds, they do have a bit of challenge when it comes to pension fund regulations. Now, that again calls for pension fund reform program. How are the regulations going to be amended or, reviewed so as to allow pension funds to be able to invest directly into infrastructure projects? Then the other point is the sovereign wealth funds that have been mentioned. I must say that the sovereign wealth funds, yes, they are there at a Pan-African level, but there are also global pension funds, sovereign wealth funds that are out there that are looking for the right risk to buy. So the right risk to buy, these are really assets that they are looking to invest in. Again, risk becomes an issue, and we need to be able to make sure that whatever assets and projects are being prepared, they are acceptable and de-risk to a certain level. When we look at, again, infrastructure projects, what we've picked up is that as a commercial bank, you can't do it on your own. Even the $92 billion infrastructure gap that we are talking about, we, even as Barclays PLC, there's no way we'll be able to carry that on our balance sheet. Then that calls for collaboration, partnership. And again, we commercial banks normally come in with short funds. In other words, because of liquidity issues, Basel III implications, now Basel IV, liquidity risk, we are only able maybe to take the short end, maybe 10, 7 years, and then we've got the DFIs who can go up to 22 years, some are even going up to 20, 25 years, and with some grace period. So it's important to actually come around the table. This is the project, and this is where I can come in as a commercial bank, a DFI will come in, insurance will come in, pension funds will come in. So it's actually an opportune time for collaboration across private sector and public sector. So in a nutshell, public sector cannot do it. Africa has to happen. The infrastructure projects, they have to be delivered, and it's actually the responsibility for all of us who are in the table, in the room, to be able to participate actively and be able to commit to be able to move the projects forward. 2 weeks ago, we were in Kigali at the WEF conference. About $300 billion worth of bank intermediated trade finance is out there. And but for trade to happen, there is also need for infrastructure. So again, we can't talk trade without infrastructure, and we can't talk Africa economic development without infrastructure. And it's all our responsibility to make it happen. Thank you.
Thank you, Zienzi. That's a very eloquent way of sharing the views of the private sector on some of these key issues. 92 billion viability gap. To be filled, that's quite, so take quite some work in a number of different constituencies. We also touched on the need that's continually being echoed by the private sector. A lot of the development partners rightfully understand the issue that the money is there for the projects, but you have to bring bankable projects to market. I think what we're saying as the private sector is it will be important to continue to create some space for the private sector project developers to create an environment for them to be able to take more risk in the preparation, because we feel that the project preparation facilities that exist presently lose institutional memory. So the money goes to, on a grant basis, to a transaction advisor that doesn't stay with the project. We feel that about 95% of the money in the market for project preparation facilities goes to the public sector, not the actual companies that are going to be taking the risk staying with those projects for the long term. So we think that's an important additional consideration as we look at how to get the best return from our development dollar or our development euro, or whichever currency we'd be looking at. And in that respect, it was very interesting to learn that up until now, the project development community has never really been organized in any sufficient fashion to be able to voice its key priorities. And that's an initiative that was inspired by the CBN that we've taken forward as Africa Investor. We now have a group of the leading 200 private sector project developers who are beginning to highlight a number of their key issues, and they found their way into some of the CBN recommendations. You also talk about pension funds and sovereign wealth fund assets and capital that's available. I mean, there are trillions of dollars out there. I think the key challenge is how can we, through some of the insights gathered today and gathered from the report and gathered from the overall process, prepare our projects. I mean, we've worked with a number of them, and their key feedback is you ask us to take risks that are suitable for development finance institutions and development partners, but we have a very different investment mandate and criteria. We have a winning, we like long-dated assets, but we need to have much more engagement on how we can align the requirements with our investment criteria to get them to participate.
Doing business in Africa, you can't afford to be without Africa Investor.